Everyone knows only central banks can print money. They have the mint, they have the presses, they decide the supply. But in the shadows, a bigger mint hums quietly day and night with no ink and no plates. Just balance sheets, collateral, and promises. It prints money without a printing press. This is Dollar's dance, in which we rig the money with simple stories to reveal the truth, and it's all about money. Because the money that moves markets, funds mortgages, and keeps corporations alive isn't always the bills in your wallet. It's a shadow twin, created, pledged, and multiplied far from the mint. Shadow banking sounds sinister. It isn't a secret club. It is a category, all the activity that looks like banking, creating liquid claims that feel like cash, transforming risk and maturity, done by institutions that aren't traditional deposit-taking banks. Think money market funds, broker-dealers, hedge funds, securities lenders, mortgage trusts, finance companies, and now even stablecoin issuers. They don't take insured deposits. They don't have central bank reserves like commercial banks do. But they still perform the same magic trick. They take long-term, risky assets and turn them into short-term, safe-feeling money for someone else. To see how they print, you have to change your definition of money. For households, money is deposits, wages that hit a checking account and can be spent immediately. For Wall Street and global trade, money is anything that settles a payment now with near certainty. $1 in a money market fund, overnight cash raised in the repo market, shares in a fund that can be redeemed on demand. If an institution can meet its obligations with it today, it behaves like money, even if it isn't legal tender. Here's the recipe. Start with a safe asset, usually a U.S. Treasury bond. Pledge it as collateral in a repurchase agreement or repo. Repo is a simple contract. I give you my treasury today, you give me cash. Tomorrow, I buy it back at a slightly higher price. To the borrower, repo is a loan. To the lender, it's a cash-like asset, a secured overnight claim backed by a top-tier bond. That secured claim spends in markets like money. And because the treasury can be repledged again and again down the chain, one piece of collateral can support multiple layers of new money-like claims. No ink, no presses, just collateral moving faster. Money market funds are the other workhorse. They accept dollars from savers and promise near-instant access at a stable value. Then they invest those dollars in short-term, high-quality instruments, repos, treasury bills, commercial paper. To the investor, the fund share behaves like a deposit. To the issuer of the commercial paper or to the dealer borrowing cash in repo, the fund's dollars are new funding born from thin air, created the instant the fund issues a redeemable share. One person's safe cash bucket is another person's brand new liability. Securitization adds more horsepower. Imagine thousands of mortgages packaged together into a bond. Slice the cash flows into tranches. The top slice gets paid first and is rated away. That top slice now looks, to many investors, like a safe asset. It can be used as repo collateral. It can sit in a money fund. It can back a short-term promise by taking risky, illiquid loans and transforming them into safe, liquid slices. The shadow system manufactures collateral, the raw material for more money-like claims. In the boom before 2008, the world flooded itself with IRA mortgage and loan paper. It wasn't gold. It was close enough for the plumbing. If this still feels abstract, watch the balance sheet. Money is created when someone issues a short-term promise that others treat as cash. In traditional banking, your deposit is the bank's short-term promise backed by its assets. In shadow banking, a repo lender's cash claim is the dealer's short-term promise backed by collateral. A money fund's shares are its promise, backed by a pool of short-term assets. A finance company's commercial paper is its promise, backed by receivables. These promises settle payments today. They are born with a keystroke, and they disappear when the position is unwound. Creation and destruction, every day, in vast size. The key to the shadow mint is the haircut. In repo, a lender doesn't give the borrower the full value of the collateral. A $100 treasury might get you $98 in cash. That 2% is the haircut. In good times, haircuts shrink. The same $100 collateral can raise $99.50, then $99.80. That means more money-like claims per dollar of collateral. The money supply in markets expands, not because the central bank printed more, but because confidence did. In bad times, haircuts widen. Suddenly, that $100 bond only raises $90. Everyone needs more collateral to support the same loans. Positions are unwound. Funding disappears. The money supply in markets contracts at light speed. That's how the shadow system booms and busts, haircuts breathing in and out. Now, rewind the tape to the Eurodollar era, the original shadow. In the 1950s and 60s, dollars began circulating outside the United States on the balance sheets of foreign banks. No American deposits, no FDIC insurance, no Federal Reserve reserves, just offshore banks creating dollar-denominated claims for global trade and finance. Those Eurodollars were book entries, not bills. Yet they financed chips, factories, and oil. They still do. It was the first lesson. You don't need the US Mint to create spendable dollars. You just need a credible issuer and a network that accepts the claim. By the 2000s, the shadow system inside the US was enormous. Broker-dealers financed securities inventories with repo. Special investment vehicles sold short-term commercial paper to buy long-term assets. Money funds funneled household savings into institutional lending. Insurers and pensions reached for yield with safe, structured products. It worked until it didn't. In 2007 and 2008, cracks appeared. Haircuts on mortgage-backed collateral blew out. Investors refused to roll asset-backed commercial paper. A single money fund broke the buck after Lehman failed, and there was a run on the shadow system. It wasn't lines outside banks. It was instant. Electronic withdrawals from money funds, repo, and commercial paper. The shadow money supply evaporated. The response revealed the truth. The central bank may not supervise every shadow institution, but when the shadow system collapses, the central bank becomes dealer of last resort. The Fed created emergency facilities to lend against collateral markets wouldn't touch. It guaranteed money funds. It funded commercial paper. It lowered haircuts with its own balance sheet. In short, it backstopped the shadow mint to prevent a total freeze. The lesson wasn't lost. After 2008, regulators raised bank capital and squeezed risk out of deposits. But risk doesn't vanish. It migrates. In 2019, the repo market spiked out of nowhere. Overnight rates shot up. There wasn't enough balance sheet room among dealers and banks to intermediate all the collateral that needed cash. The Fed stepped in with repo operations, then later installed a standing repo facility, a permanent offer to turn good collateral into cash at a known price. If shadow money is born in repo, a standing facility is a standing printing press for institutions. In March 2020, the world ran again, but this time toward cash of any kind. Funds dumped everything to raise dollars. Even treasuries, the world's safest asset, went no bid in places. The Fed bought at scale, opened swap lines to foreign central banks, and created a facility so foreign reserve managers could borrow against treasuries instead of fire selling them. Again, the central bank didn't just support banks, it supported the shadow system's collateral engine. The message was clear. In a market-based credit world, monetary policy is as much about collateral as about currency. Printing reserves for banks is one thing. Printing confidence for dealers is another. So how, exactly, does shadow banking print money? It manufactures now claims against later assets. Every time a fund issues a redeemable share, every time a dealer borrows overnight against a bond, every time a finance company rolls commercial paper, new now claims appear. If holders treat those claims as cash equivalents, they spend like money. The supply grows when haircuts fall, when safe collateral proliferates, when risk looks tame. It shrinks when haircuts rise, when collateral is doubted, when risk erupts, the engine is procyclical, booms oversupply money-like claims, busts destroy them. The collateral at the center shifted after 2008. AAA mortgage paper lost its halo, treasuries became the new gold. That made the government the ultimate supplier of shadow money's raw material. When the Treasury issues more bonds, it's not just funding a deficit. It's minting collateral the entire system can transform into cash on demand. That's why Treasury market plumbing matters so much. Clearing capacity, dealer balance sheets, leverage rules, and repo backstops are not footnotes. They determine how much shadow money can exist without breaking. There's also a political economy to this. Regulation made banks safer by design. More capital, more liquidity, stricter rules. That pushed credit creation outward. Corporations rely more on market funding. Savers pour cash into money funds. Hedge funds do basis trades that turn treasuries into synthetic dollars. The official money supply numbers, M1, M2, don't fully capture this universe. And when you ask, where did all this money come from? The answer is often from a dealer's spreadsheet and a fund's promise, and the frontier keeps expanding. Stablecoins take the old money fund model and bolt it onto blockchains. Dollars flow into a token issuer. The issuer buys T-bills in repo. In return, it issues a digital claim redeemable on demand. Those tokens trade 24/7 and settle instantly. To their users, they are money. To the market, they are another shadow mint, turning sovereign collateral into spendable claims without a printing press. If that sounds familiar, it's because it is. The technology changed. The balance sheet logic did not. None of this is free. If shadow banking can print money, it can also unprint it. A sudden spike in haircuts, a loss of confidence in a class of collateral, a regulatory tweak that jams balance sheets, a run in money funds or stablecoins. The contraction is swift, prices gap, liquidity vanishes. And because the shadow system is deeply entwined with everything, mortgages, corporate funding, trade finance, the pain spills into the real economy. We've seen it in 2008's run on repo and money funds. We've seen it in 2019's repo stress. We've seen it in 2020's at Dash for Cash. Each time, the only true backstop was public power. That raises an uncomfortable truth. We privatized money creation across a sprawling network of nonbanks, but we socialized the last resort guarantee. When things are calm, the shadow system mints extra money, juices credit, lowers costs, and flatters growth. When things are wild, it calls the central bank and asks for a floor under the falling elevator. Lender of last resort became dealer of last resort, a guardian not only of banks and deposits, but of collateral and market plumbing. It works, but it blurs the line between public and private money creation in a way that is easy to miss and hard to unwind. So where does that leave you? First, with a clearer map, money is not a single thing. It's a spectrum of promises, from the government's cash, to bank deposits, to overnight repo, to money fund shares, to tokens backed by T-bills. Second, with a clearer risk, the part of the spectrum that grows the fastest in good times tends to evaporate the fastest in bad times. If your savings or your business depends on a promise that can be withdrawn on demand, ask what collateral sites behind it and who will catch it if that collateral is shunned. Third, with a clearer paradox, the same shadow system that sometimes threatens stability also keeps credit cheap, markets liquid, and the dollar dominant. Turning it off would be like ripping out the wiring of a city while the lights are on. So how does shadow banking print money without a printing press? By pledging safe assets as collateral, issuing short-term promises that everyone treats like cash, and reusing those assets until the system hums. It's collateral alchemy, the transformation of later into now, repeated across thousands of balance sheets. As long as trust holds and haircuts stay tight, the supply of shadow money expands and the economy glides. When trust breaks, the presses jam. We remember the difference between money that is guaranteed and money that only felt that way. If this gave you a new lens on the cash that actually moves the world, subscribe. History has the answers. I'll show you where to look.